Right, get this. Someone in the comments last week called me a glorified gambler who just draws crayons on a screen.
Mate, they're not wrong, are they? I've seen your Bitcoin charts. Looks like a toddler's had a go at it. Cheeky git. My crayons predicted that last dump, didn't they? But it brings up a good point. How do you separate the real technical analysts from the cowboys? And that, people, is where ethics comes in. Right.
Sounds boring, but trust me, it's juicy.
It's the difference between being a professional and being, some random bloke on Twitter shilling his bags. Yeah. We're diving into the CMT Level 1 Code of Ethics today. Basically, the rule book for how not to be a dodgy trader.
Exactly. So the first thing to know is that the CMT Association, right, the big dogs of technical analysis, they didn't even write their own rules.
Oh.
They nicked them.
He says nicked. The professional term is licensed.
Right. They adopted the CFA Institute's Code of Ethics. And that's a big deal. The CFA guys are the pinstripe suit fundamental analysis mob. Think balance sheets and earnings reports. And we're the cool kids in hoodies looking at charts. So why are we using their rulebook?
Well,
is it just to make us look more grown up?
Pretty much. It standardizes everything. It says that whether you're looking at a company's debt-to-equity ratio or a head and shoulders pattern on a stock chart, you have to operate with integrity, competence, and professionalism.
Okay.
It gives technical analysis that stamp of legitimacy. So it's like a bouncer for the industry. You follow the rules, you get to stay in the club.
Yep.
You start acting dodgy, you're out. Your CMT charter, gone. And that's crucial. I mean, think about the crypto space. Your mana, Chris. It's the Wild West.
It is.
Everyone's a guru. Everyone's got a call. Do you think a universal code of ethics would even work there? Or is the code is law mantra the only thing that matters?
That's the million-dollar question, isn't it? People love the freedom, but they get absolutely wrecked by scams.
Right.
A bit of professionalism wouldn't hurt, which leads us perfectly into the spiciest bit of the code.
Go on.
Dramatic market manipulation. Standard 2IB.
Now we're talking. This is the big one. It basically says you cannot, under any circumstances, try to mislead people by faking the market.
Right.
It's broken down into two types. First, there's information-based manipulation, the classic pump and dump, spreading fake news, getting everyone hyped up to buy some dead-end stock or a new shitcoin. Exactly.
You ride the wave up, and then you dump all your bags on them at the top.
Exactly.
The guide literally gives an example of a guy who starts a rumor campaign on blogs and social media just to pump a stock he wants to sell. It's what half of crypto Twitter does for a living. Don't look at me. My analysis is pure, unlike you Forex boys with your whispers about what their central banks are going to do. We deal in facts, my friend. The other type is transaction-based manipulation. Okay, this is even sneakier. This is where you trade to create a false impression of activity. Wash trading. That's a huge thing in the NFT space.
Yep.
You sell an NFT back and forth to yourself through different wallets to make it look like there's massive demand and a rising price.
Precisely.
Or placing a massive buy order to make it look like there's huge support.
Yeah.
Just to cancel it before it ever gets filled. It's all smoke and mirrors. And for us as technical analysts, this is poison. Why is that? Because our entire world is built on price and volume. We believe the chart reflects the collective psychology of the market.
Right.
But if that price and volume data is fake, what are we analyzing?
Nothing.
The chart becomes a lie.
Exactly.
Your indicators, your trend lines, your patterns, they all mean sod all.
Exactly.
So this rule isn't just about being a nice person. It's about protecting the very foundation of technical analysis.
Okay.
The key thing the CMT hammers home is intent. Are you entering a trade because your strategy gave you a signal, or is your intent to deceive other market participants? That's a sharp line. You see a stock moving, you jump in.
Right.
Someone else sees you jump in and they follow. Is that manipulation? No, that's just the market. Manipulation is when you're deliberately creating a false picture. Like a manager of two funds who starts trading a stock back and forth between them just to create fake volume and lure in other buyers. That's a direct violation. Got it. So don't be a puppet master, just read the charts. Yes. Which brings us to the next point, professionalism and objectivity. This sounds a bit fluffy. It's the opposite of fluffy. It's what separates a real analyst from a hype man.
Okay.
The first part is independence and objectivity. Your analysis has to be your own, not influenced by anyone else. So, if a company flies you out to their swanky headquarters,
Right.
puts you in a 5-star hotel, you can't just go and write a glowing buy report because they were nice to you. Well, you'd have to disclose it for one, but your analysis must remain objective. It also means you can't just talk up a stock because you secretly own a massive bag and you're desperate for it to go up.
Yeah.
Your personal holdings can't cloud your professional judgment.
That's a big one. You see it all the time. An analyst on TV goes on a massive rant about why a stock is going to the moon, and you just know they're sat on a huge position.
And that leads to the next bit, misrepresentation. You can't lie or exaggerate about your analysis or performance.
Right.
You can't promise the future.
Ah, the classic, this setup has a 100% win rate or guaranteed 10x returns that you see on Instagram ads.
That's a massive violation. You also have to be clear about the process of your analysis. You can't just show a chart with a line and say, it's going up.
Yeah.
You have to explain the indicators you're using, the patterns you see, and the assumptions you're making. You have to show you're working like in a maths exam. Exactly. And you must distinguish between fact and opinion, stating that the 50-day moving average just crossed above the 200-day moving average is a fact.
Right.
Stating that because of this golden cross, the stock is about to rocket is an opinion. That's a brilliant distinction. It all comes down to credibility, doesn't it?
Totally.
If you're seen as an objective voice who does solid, honest work, people will trust you. If you're just the shill who pumps and dumps, you'll get found out. In the long run, yes, the market has a way of weeding out the charlatans. This code of ethics is just a framework to speed up that process and protect people along the way.
Right.
It's about holding technical analysis to a higher standard so it earns its seat at the table of serious financial disciplines. So, to boil it all down for the crayon drawers like me, 1, play by the rules to keep the profession legit. 2, don't fake the market because it screws up our charts. And 3, be honest and objective so people actually believe what you're saying. Couldn't have said it better myself. Maybe there's a brain under that hoodie after all. Just for that, you're buying the first round next time. All right, that's our time. We want to hear what you lot think. Is ethics a joke in the markets, or is it the only thing holding it all together? Get in the Big Short Club chat group and let us know. The link's down below. Hop in and have a laugh with us. We'll be in there debating this, probably. Come and tell Chris his charts are rubbish. Do not. Anyway, before we go, we want to leave you with a question to mull over. Now, here's a question we'd like you to think about. In an age of AI and algorithmic trading, where bots can execute thousands of trades a second based on complex signals, what does ethical trading even look like? Who is responsible when an algorithm manipulates the market? The programmer, the firm that owns it, or no one at all? Chew on that. We'll see you in the next one.
Cheers.